Very good afternoon from London. Welcome to the RANsquawk Weekly Wrap. Just going to run through a couple of the questions we've had through to the desk this week. So non-farm payrolls then coming in at 120,000, slightly below expectations of 125 after the earlier whisper numbers of above 200,000 on non-farm payrolls figures being stemming from the positive data we've seen out of the US over the last week or so, particularly the ADP number. The attribution has been through the labour force participation rate, which has dropped from 64.2 to 64%. So it's more of a case of people dropping off the radar altogether. So politically, the unemployment rate falling by 0.4 percentage points does look very good on paper. However, the underlying economic strength needs to be showing to increase the jobs a lot more than 120,000 in order for the US economy to pull itself out of a possible double-dip recession. We already had the IMF this week forecasting cuts in GDP, particularly for the US. However, they do not see the US going into a double-dip. But just then, the initial optimism seen following the release of NFP and the unemployment data just seems to be wearing off the market slightly as market participants just digest this data and see that all things are not rosy in the US, and a lot will remain then on the European data as we move forward through the rest of next week. So elsewhere, the major thing to consider this week has been the liquidity action taken by the global central banks as they have decreased the swap rate for dollars by around 50 basis points. We're already seeing the dollar funding, the liquidity problems, particularly in the French banks, affect the markets quite considerably in terms of confidence. It remains to be seen whether this effect will be lasting. There was a minor dip in the 3-month dollar LIBOR rate immediately following the action taken by the central banks, but again today there being an increase in the 3-month dollar LIBOR rate, so it does seem to be a very temporary effect here, and it remains to be seen how much funding stress this will take off the banks as we move forward, as they remain in the focus. We've already seen a potential warning coming out from UK banks saying that they are preparing in eventuality of a Eurozone breakup. They've been urged to increase their capital buffers by the UK government as a crisis does seem to be coming to a head. There will be a lot of focus then on the December the 9th discussions where market participants are anticipating a catch-all solution to the Eurozone problems, which does seem very far away, but focus remains then on the banks, particularly those French banks which have been suffering from the dollar funding problems. Well, that's enough from me then. Hope you've had a great trading week. We very much enjoy doing these videos for you, for our RANsquawk listeners. Hope you have a good weekend, and we'll see you bright and early next week where we have the Bank of England and ECB rate decisions to look forward to, particularly that ECB rate decision where analysts are expecting another cut in the ECB rate. But we'll see you for that next week. Have yourselves a great rest of your trading day.